been an exciting period of time.
There are some signs that there may be cracks in the dam. What indicators are you kind of paying attention to?
How much time do you have? We've seen some rotation. We're in a seasonally volatile time of year. Is technology, is this AI trade going to continue? I think industrials have done very well. Energy has done well. The only area that's really struggled this year has been real estate. We've seen this period of what you'd call rolling recessions that kind of impact one sector but don't impact other sectors.
Welcome to Wealth Strategies Unleashed with Concenture Wealth Management. I'm Robert Gilliland, and today we have with us
Mike Alexander.
Hey, Mike, thanks for coming in.
Thanks for having me on.
It's always good to have the Chief Investment Officer of Concenture on our to break away from all your analysis and have you come in and spend a little bit of time. And I think there's a lot of things that are going on right now. But first, what's been going on with you? How's life? Everything going well?
Everything is going well. You know, it's a busy time of year. You typically would think that, you know, with summer vacations and lots of things happening during the summer relative to family and other things that, you know, you're going to get a little bit more time off. I was able to do a little bit of that, but you know, now we're back in the throes of election season, and we just went through, you know, the second quarter earnings. It's been an exciting period of time.
And very important, we're in the new Wealth Strategies Unleashed studio. It is absolutely fantastic to be in the studio. It's going to be fantastic as we go forward, and feels good, doesn't it?
I love the new digs.
And so it's good stuff. Hey, look, you know, you brought that up about election season, about the markets, about earnings, about companies, and as you've been calling and we've been calling ever since the beginning of the year, we're having some volatility. There are some signs that there may be cracks in the dam. As you kind of go through, what indicators are you kind of paying attention to as we kind of finish out this year, and kind of what's your, not to overload you with questions, but what's your kind of thought process as we kind of look forward here?
Yeah, how much time do you have? You know, in all honesty, I think we've come through this period where I think the central bank, Federal Reserve, has been very, very keenly observant of inflation. And I think we've reached a point now where it's become apparent that inflation is gradually working back to that, you know, that 2% target that the central bank really has been looking for. Now, you might also remember that they have a dual mandate. And so while inflation is one of those, the second one of those is full employment. And so we've gone through this period as well where the unemployment rate has slightly drifted up from that, you know, 3.8% range, right, and is now hovering around 4.3%. And so to a certain degree, I think the central bank has had the ability to kind of check off one box and now shift their attention to the other, and that's employment, which obviously has been weakening a little bit of late.
You know, what's interesting is I think it was last year when we were sitting down with clients, one of the things that you were telling clients to be aware of is that we would possibly see unemployment get as high as 5%. That wouldn't be out of whack before the Fed kind of turned around. And what's amazing is that it took us a long time, but it's kind of starting to look like that kind of going on. And what's interesting is it seems like a lot of tech companies are laying people off, retail,
sure,
those kind of things. If there were two kind of things that people need to pay most attention to, what would you say with regard to the economy? And I understand that the economy is not the market, but what would be the two things that maybe kind of give you pause or that you're keeping really good?
We're in a seasonally volatile time of year. September, usually markets tend to peak in the late part of the summer months. And then when we get into that September, October timeframe, things become a little bit more volatile. You know, we always like to say here in Texas that volatility can be mitigated by football season, and we'll see if that's actually the case this time as the season, college football and pro football get ready to kick off here soon.
What's interesting to me is that the markets and the economy are not the same. You can have an economy that's doing okay to poor, but the markets still are good. You can have a market that is doing poorly, but the economy is actually good. They're not necessarily directly correlated. But if we were to go through, when you go to think about the economic factors, the market forces that are in place, what sectors are ones that we expect to perform well, and which ones are ones that we should maybe be aware of that not necessarily there's a tremendous amount of downside risk that may not do as well?
It's a great question, and I will say that throughout any 1 year period, 1 calendar year period, you'll see that change a little bit. When we came into this year, we favored areas like technology, we favored energy, we favored utilities. In the latter part of the first quarter, we favored industrials. I think a lot of those areas continue to exhibit leadership. I think the question we get a lot relative to sectors is technology, is this AI trade going to continue to move forward? And I would say that we're probably in the early days of that. We don't necessarily know who all of the winners are, outside of the fact that NVIDIA has clearly been been the darling of the AI space. But there are other winners associated with that particular area. I think industrials have done very well. Energy has done well. And really, when you look across the broader market, the only area that's really struggled this year has been real estate. And even in the last couple of months, even that area has been one of the top performers. And so we've seen some rotation. We've seen this period of almost what you'd call rolling recessions that kind of impact one sector but don't impact other sectors. And so you can't really see it on the surface of the market. And as we sit here today, the S&P 500 is up roughly 18% on a year-to-date basis. I think a lot of people would take that. Other parts of the market perhaps not doing as well. Small and mid caps have lagged, but even those areas have come on strong. And so we've seen a little bit of broadening.
Which is important. We needed that, right?
Sure.
Because the last 18 months or so, it's been a one-trick pony, and that is 7 stocks pulled this whole thing through.
Absolutely.
We really need something to change, right?
And the broadening is I think there's a function of a couple of things. One, we just have an enormous amount of cash that's been piled up on the sidelines for quite some time. It's been piled up earning a pretty good rate of interest as it sits on the sideline. And so one of the things that I think we want to make sure we're paying attention to, investors want to certainly be watching for, is what's going to happen with all this cash once the central bank finally begins to lower rates. It's not going to happen all at once, but eventually some of that's likely to flow out into the marketplace. I happen to be a fan, I always have been a fan of dividend-paying stocks. I think some of the money winds up going to some of those areas, and maybe we start to see some continual broadening that factors in other parts of the market that perhaps have not been participating to the degree that technology has over the last couple of years.
The thing that I think of is, especially with the Magnificent Seven and Bob Farrell's 10 rules of investing, one of them is if you think this time it's different, it's not. And it's interesting. And the other thing that I think about is that in college I had a professor that said when your barber tells you about a stock, it's time to sell. And the thing I find interesting is that it's pretty difficult to find someone who either doesn't have a question or already own some of those Magnificent Seven, right? That's NVIDIA, Microsoft, Meta, Apple, Amazon, Google, and Tesla. It's always difficult for me to name all of them, but this time it's different, right? Now Tesla's obviously suffered a little bit. You've got some of these. At some point, their valuations are out of whack. We don't know exactly where that is. The market will determine that. Given kind of where the markets are and as we look, so basically what I hear you saying is let me back up. This is really interesting. I was on a couple podcasts last year as a guest, and one of the things we talked about is that everyone was always worried about October because we've always had the Black Tuesdays in 1987 and 1929, and it seems like October, everyone thinks that October is a bad month. October is not a bad month. That volatility really starts about mid-August through September, and then it kind of kicks up. And as we're looking, and especially in an election year and things like that, what sort of strategies, given these current trends and the forecast that we have for the rest of this year, what should people be doing now with their investment portfolios, if anything?
Yeah, so first of all, I think it's always, there's never a bad time to rebalance a portfolio, but I think certainly if you're invested in markets and you've seen parts of the marketplace really do well, I think rebalancing to some of the areas that you own within your portfolio that maybe haven't done as well, I think that it always makes sense. I think to your point, October, which is, gets a bad reputation for being, a bad month.
Right.
Historically, I believe it's typically September. For parts of the market this year, the NASDAQ, for example, hit a peak in mid-July. It will probably hit another one before the end of the year. And I think things actually look pretty constructive between now and the end of the year. But the fact that you do have, a mountain of cash piled up on the sidelines, that cash is eventually going to get committed somewhere. And growth is reasonable. It's not great, but it's reasonable. And I think we're in this period where, to a certain degree, it kind of has this Goldilocks looking, look to it, if you will. And valuations are not cheap, but they're not exorbitantly excessive either. And as long as growth and the consumer continue to hold up, then I think we have this ability to grind a little bit higher. I do think the sledding is a little bit tougher, so we might get some air pockets that you hit along the way. Perhaps those will be good opportunities to put some idle cash to work in some names that you really, really like. And I think that the types of names that have been winners thus far this year are likely to continue to be winners until the valuations again become excessive. And I don't think they're necessarily excessive right now. And by the way, we're pretty late in this, this bull run, if you will, that we've had. But bull markets don't typically end where we are here. They end exactly in those types of scenarios where everyone and their brother is asking you or telling you what they're actually buying. I need to buy this. They usually end when everyone is bullish, and I don't think that's where we are right this second. Does that mean we can't get there? Absolutely not. We can, but I do believe that the path is likely higher, even if it is a choppy one.
You know what's incredible? Couple things. Number one is that as you look through the end of this year, people who have to take the required minimum distributions out of their IRAs, and they generally take that as cash, it may be a good time to be looking at that as opposed to waiting until late November, December to take those required minimum distributions. Roth conversions, again, it may be another opportunity to take those, reset the balances, and get. Those are two things that are really important. The thing I find really, really interesting with regard to what the Fed speak and the market's reaction to the Fed, right? So if you go and think about this, the Federal Reserve is not cutting rates because their outlook for the economy is as strong as what they want it to be. Their outlook, the reason why they cut rates is they think the economy has some risks. But the markets are like, hey, they sneezed and it sounded like we're going to cut rates, and the market shoots up. Well, the reason why they're going to cut rates is because the economy is showing warning signs. They want that growth to pick up. I always find it very interesting. Now, there's some sectors and things like that that can benefit inside of that. Financials may be opportunities. Housing may be one. It's really interesting that 6 months ago when we told people that we were adding utilities, they were like, "You're adding utilities? I'm not a grandpa. I don't need to have utilities." And that was one of the best performing sectors. Healthcare, which really hadn't done very much in the last 18 months and going through, and that's been done very well. Real estate, like what you said just recently.
I think a soft labor market can be very worrisome. It's something that we want to, certainly want to keep in mind. And by the way, holding a little bit of cash in reserve, not a bad idea. I understand that, maybe it's not going to be paying in the next 12 months what it's paid in the last 12 months. But that makes a lot of sense. Having a little bit of dry powder, never a bad idea, particularly as you come into election season and the people start shifting around their chips in terms of where they think winners and losers are going to be.
So kind of as takeaways, the reality is that the market, the economy, they're not too hot, not too cold. They're kind of just right, that Goldilocks. There's probably more upside to equities. If they cut interest rates, there's probably upside to fixed income. There, you need to make sure that you're well balanced, well diversified, because this market seems to be it seems to be broadening, where other sectors, as opposed to just technology, seem like there's an opportunity. Energy's probably still an opportunity. Financials, healthcare, those type of things may be places that can come in and benefit. Is there anything else that you think that we need, that investors, with regard to the market as we look forward for the rest of this year, need to keep in mind, or have we come?
Yeah, I would just say stay vigilant. Again, it's an election year, and election years sometimes can bring some volatility. Sometimes that volatility doesn't come until after the election. And so I think it's one of those environments where you want to be flexible, you want to be nimble. Keeping a little cash on the sidelines, not a bad idea as we head into the latter part of the year. And keep your eyes on the employment figures. We can get some surprises on inflationary data from time to time, but keep your eyes on the employment data, because that's one of the things that the Fed is certainly very, very paying a lot of attention to.
Awesome. Well, Mike, thank you. I know there was a lot of really good information, and I look forward to having you back here real soon.
You bet.
Awesome.
Thanks.
Thank you for joining us this week on Wealth Strategies Unleashed, and we look forward to seeing you next week.
The information contained herein is intended to be used for educational purposes only and is not exhaustive. Diversification and/or any strategy that may be discussed does not guarantee against investable losses, but are intended to help manage risk and return. If applicable, historical discussions and/or opinions are not predictive of future events. The content is presented in good faith and has been drawn from sources believable to be reliable. The content is not intended to be legal, tax, or financial advice. Please consult a legal, tax, or financial professional for information specific to your individual situation.
This work is powered by Concenture Wealth Management, registered representative of Sanctuary Securities, Inc., an investment advisor of Sanctuary Advisors, LLC. Securities offered through Sanctuary Securities, Inc., member FINRA, SIPC. Advisor services offered through Sanctuary Advisors, LLC, an SEC registered investment advisor. Concenture Wealth Management is a DBA of Sanctuary Securities, Inc. and Sanctuary Advisors, LLC.